In January 2019, this company was valued at $47 billion, more than most airlines, more than Ford Motor Company. 8 months later, its attempt to go public collapsed so completely that its valuation was slashed by more than 80% in a matter of weeks. And its charismatic founder was pushed out of the company he built. The company didn't invent a new technology. It didn't discover a new market. It rented office space, then re-rented desks inside that space at a markup. This is the story of WeWork, and how one founder's total control over his own company is what nearly destroyed it. To understand how WeWork imploded, you first have to understand the very ordinary business it dressed up as something extraordinary. Co-working, renting flexible desk and office space to freelancers, startups, and small teams, wasn't a new idea. Executive suite companies had been leasing furnished office space for decades before WeWork existed. It was, at its core, a real estate business. Sign a long-term lease on a building, subdivide it, then rent it back out short-term at a higher price. In 2010, Adam Neumann and Miguel McKelvey opened the first WeWork location in New York City, built on the idea that the same business could be reframed entirely, not as a landlord arbitraging leases, but as a community and a movement selling not desks, but belonging. Investors, it turned out, were extremely receptive to that story. WeWork's early growth was fast. By 2014, the company had expanded into multiple U.S. cities and abroad, and had already raised funding at a valuation north of $1.5 billion. Neumann proved to be an extraordinarily persuasive fundraiser, tall, charismatic, and unwavering in describing WeWork not as a real estate company, but as a technology platform poised to reshape how the world worked, sometimes framing its mission in almost spiritual terms, talking about elevating the world's consciousness. That framing mattered enormously, because technology companies are valued very differently from real estate companies. Real estate companies are valued modestly, based on predictable rental income. Technology companies are valued on growth potential, often at many multiples higher. By convincing investors WeWork belonged in the second category, Neumann unlocked valuations far beyond what a conventional office leasing business would ever command. The single biggest believer in that story was SoftBank's Masayoshi Son. After a now famous 2017 meeting in which Son reportedly told Neumann he wasn't being crazy enough, SoftBank poured billions of dollars into WeWork, eventually investing more than $10 billion total. By January 2019, fueled by SoftBank's backing, WeWork was valued at $47 billion, one of the most valuable startups in the world. Neumann, meanwhile, had structured the company almost entirely around his own personal control. He held a special class of shares giving him outsized voting power. He personally owned several buildings that WeWork then signed leases on, meaning the company was, in effect, sometimes paying its own CEO's real estate portfolio. He had personally trademarked the word "we," and in 2019, WeWork paid him $5.9 million to buy the rights to its own name back from him. None of this was hidden. It was simply overlooked until the company tried to go public and was legally required to write all of it down. In August 2019, WeWork filed the paperwork required to go public, an S-1 filing, which lays out a company's finances, structure, and governance in detail for public investors to review. For the first time, the wider financial world could see in writing exactly how WeWork's business actually worked. The numbers themselves were alarming. The company had lost roughly $1.9 billion the previous year alone on a business model that still fundamentally depended on signing long-term, expensive leases and hoping short-term memberships would cover the cost. But it was the governance details that caused the real panic. Neumann's related party leases, his outsized voting control, the trademark payout, and a pattern of decisions that appeared to blur the line between Adam Neumann's personal interests and WeWork's interests as a company. Here's the irony underneath all of it. The exact same total, unchecked control that had let Neumann move fast, raise enormous sums, and build WeWork's cultural mystique in the first place was now laid out in a public filing, the very thing making the company look impossible to trust as a publicly traded business. Investor confidence didn't erode gradually. It collapsed almost immediately. Within weeks of the S-1 filing, WeWork's targeted IPO valuation crashed from $47 billion toward estimates as low as $15 billion, then kept falling. Major investment banks that had once championed the offering began distancing themselves. Media coverage shifted almost entirely toward Neumann's governance structure and erratic leadership style rather than the business itself. By mid-September 2019, the IPO was postponed. By the end of the month, Neumann had stepped down as CEO under pressure from the board and from SoftBank, though he retained a significant financial exit package, reportedly worth more than $1 billion between severance, stock buybacks, and a consulting arrangement, a payout that drew its own wave of public criticism given the scale of the company's simultaneous unraveling. WeWork itself didn't disappear immediately, but it never recovered its former scale or ambition. SoftBank, having already poured in billions, was forced to inject billions more just to keep the company solvent and avoid a total collapse, while writing down the value of its investment by tens of billions of dollars. Thousands of WeWork employees were laid off in the aftermath. Office locations across multiple countries were closed or renegotiated. The company that had once been valued at $47 billion eventually went public in 2021 through a much quieter path, a SPAC merger, at a valuation of roughly $9 billion, a small fraction of its 2019 peak. That reduced version of WeWork still couldn't make the underlying business work. In November 2023, WeWork filed for Chapter 11 bankruptcy, citing the same fundamental problem that had existed from the beginning: too many expensive long-term leases, not enough revenue to cover them. WeWork emerged from bankruptcy in 2024, under new ownership, restructured and dramatically smaller than its former self, with many leases renegotiated or exited entirely. Adam Neumann, meanwhile, left WeWork with an enormous personal fortune intact despite the company's collapse, and by 2023 had launched a new real estate venture, Flow, focused on residential rather than office space, reportedly backed by a large investment from the same venture capital firm, Andreessen Horowitz, that had once been a major WeWork investor. Masayoshi Son and SoftBank absorbed one of the largest single investment losses in the firm's history, a result Son himself later publicly acknowledged as a costly lesson in due diligence. WeWork's story isn't really about office space. It's about what happens when a founder's total, unchecked control over a company, the very thing that lets him move fast and build a persuasive story fast, becomes completely invisible to the people funding him until the law requires him to write it all down in public. It's a pattern that shows up again and again in business history. The mechanism behind the meteoric rise is often the exact mechanism that guarantees the collapse once anyone is finally required to look closely. And it's a pattern investors are still, to this day, prone to missing, right up until the paperwork forces them to see it. If you'd like to understand the hidden forces shaping our global economy, help us by subscribing to our channel.